On the x-axis, we have traction. What does traction mean? It could mean you have an idea. Maybe you've taken that idea and you've created a mock-up. Maybe you have a MVP, short for minimum viable product. So you have a prototype or something that people can actually look at and use in some capacity. Maybe you have pilot programs, paid pilot programs. You put your product in the market in some capacity, and then later down the road, you actually get to revenue, recurring revenue maybe, and maybe it's $10,000 per month, $100,000 per month, and once you get into those bigger numbers of revenue, then you start to look at these multiples and option number 2 and 3 here. Now, when we think about valuation, there's this dotted line right here that's kind of in the middle. It's at a $6 million valuation. And this is kind of like the benchmark as you move through this x-axis. So let's say you have a minimum viable product and you're kind of just you're building a startup, right? There's nothing, you're not a famous founder. You've done something. $5 to $7 million might be a fair valuation if maybe you're pre-revenue or you've just started to get revenue. This is kind of the territory you're in. Anywhere from $3 to $7 to $8 million. Now, location does factor into this. If you're in Silicon Valley, you're gonna be able to push a higher valuation for having less traction. If you're not in Silicon Valley, you're gonna need more traction to have the same or even a lower valuation. But remember, having a higher valuation is not the end game. It's the end game at a liquidity event, at an IPO or an acquisition. When you're early stage, it actually doesn't matter as much. And if you're the early stage investor or the entrepreneur, you want to avoid setting the valuation too high of a benchmark to reach before your next round of funding. So you might have a down round of funding. That's what you don't want. Now, a few different factors that I want to throw in here. This green line is the average startup. So as time moves on and you build more and you have more traction, the valuation will go up. And these outliers are other variables that take effect. So, for example, let's say you do a startup accelerator. Normally these programs have a fixed valuation, fixed terms. That's actually much lower. Normally, $1 to $3 million valuation, or valuation cap rather. And it doesn't really matter how much traction you have. So you could be making, $100,000 a month in revenue. Heck, you could be doing $1 million a month in revenue, and you're still gonna be at a fixed $2 million valuation cap. On the flip side, if you're Elon Musk, he's a crazy example, but if you're a successful serial entrepreneur, investors will have more confidence in you, and you can have less traction, and you can have a higher valuation or valuation cap. And so when we have quadrants here, a higher value in the eyes of the investor is obviously a lower valuation for more traction. You're getting a better deal. If you have to deal with a higher valuation for less traction, you're technically not getting as good of a deal. Now, if you remember what I talked about in the beginning when it comes to that liquidity event, ideally the company is much, much more valuable than when you're investing. So if we're talking about a $12 million valuation, if you're investing here and there's very little traction, you're very bullish and excited about this company's opportunity to 10 or 100x its value. If it's at 10 million or 12 million valuation, you want the company to sell for at least $100 million, or else you don't really want to be playing in this category, because there's a lot of potential that the company goes nowhere, because the further along you are down this road and the more revenue you make and the more profitable you can be, the less risky the investment is. So if you're investing at the origin point, at the idea, you have the highest risk because nothing has technically been done yet. And if you're investing at the highest valuation, that might be drawing some red flags, because you have to really believe in that famous founder, that entrepreneur, that they're going to be able to execute, de-risk your investment, and justify that higher valuation down the road. Now, I have a few other things on here. I have Silicon Valley, non-Silicon Valley. I have YC. This is a different kind of startup accelerator that is probably the most prestigious in the world. And at their demo day, even though their terms are at that, 1 or 2 million, I forget what it is exactly, valuation cap, at the demo day, a lot of these companies will raise at 10 or 15 million valuation caps, sort of regardless of where their traction is at. That's kind of at a minimum. It'd be very difficult to find a company at the YC demo day raising anywhere from, $3 to $5 million, even if they're super early stage. It's just not gonna happen. So if you're the investor and you're looking to make an investment, you don't want to be investing at the lower value, obviously, unless you personally know the founder and you really have good conviction about this market or this entrepreneur. You want to be finding these higher value companies. And if you see a company that has a lot of traction and they're raising at a very low valuation, you also want to, intrigue as to why the valuation or valuation cap is so low. What is wrong? What have you missed in their financials or the market or the multiple that really is causing this? I'll give you a quick example about my company and how we raise money. Here's an example. We raised in 2017 at a $5 million valuation cap online on WeFunder through equity crowdfunding. In that round, we were a $5 million valuation cap. We were past the MVP. I mean, we were App of the Year by Apple. So we had a little bit of revenue, but it was still very early. So I wouldn't say we weren't even 10,000 per month. I don't think we were, sort of in this territory. So, at a $5 million valuation. So we were probably about here. Fast forward to 2019, we raised again equity crowdfunding on WeFunder at a $10 million valuation cap. So just following this chart, you'd expect us to be about here, 100K per month. And we were on that track. I think in that month where we opened the round, we were around 100,000 in revenue. So as you can see, over time, as we de-risked the investment, we made more revenue. Our valuation cap, we doubled it. Now, if you guys are interested in how we raised over $500,000 through equity crowdfunding, I did a video specifically on that. Make sure you check it out. I'll link it in the description. Now, one of the dangers of high valuations that I didn't really talk about, obviously you don't want to invest at too high of a valuation or the entrepreneur because you might not get to that and you might have a down round, and the whole point of being an investor is that you see an appreciation of your investment. Now, also to consider the lead investor or the venture capitalists, or on Shark Tank it'd be Mark Cuban or one of these investors, they're the ones setting the valuation of the investment round. It's not you, the angel investor, that's coming in. If you're watching this video, you're not the one setting the terms. So it's really important that you look at this and you decide for yourself if that investment is a good opportunity, because the valuation has already been set. This is not really negotiable unless you're the entrepreneur. You can negotiate with the investor. And finally, 3 mistakes that entrepreneurs and investors make is, number 1, comparing your startup to a startup that just sold in the public market or was acquired recently. There's so much information that you don't know about the growth rate, the revenue, the motivation of the acquiring company as to why they bought that company, why they made that investment. And so because of that, it can be dangerous to set your valuation marks based on a company that was recently acquired. Now, on the flip side, that might be the best information that you have, so it's not necessarily a bad thing, but you don't want to put all your eggs in that valuation just off of what another company did. That wouldn't make any sense. You want to look at other variables, other factors. Number 2 mistake is comparing to a public company. Yeah, this doesn't make any sense. Now, the public company, the public market can be very volatile, emotional, but at the end of the day, you're going to return back to these KPIs. You're going to look at profitability, earnings, forward PE, trailing PE, PAG ratio. All of these things actually matter in the long run of a public company. In startups, most of that stuff doesn't matter for the reasons that we talked about. You might be, a little bit of revenue or pre-revenue, so none of that really matters. What matters is, this level of traction, the founder's conviction, the supply and demand of investment capital and the startups in the ecosystem. All of that factors in. So don't look at a public company. And thirdly, using a one-size-fits-all approach. We already talked about this. Basically, you have different multiples for different types of companies, different industries, different locations. If you're raising, professional investors, if you're raising online equity crowdfunding, regulation A, regulation D, right? All of these things factor in to what the valuation of the company is. But if I had to summarize this entire video, what you need to do is you need to make sure that you understand the variables at play, what the valuation is of the company today, and how that compares to the traction and your thoughts on where the company can be in the future, so that you can see an appreciation of your investment based on the future value of the company. I hope this answered some questions on early stage valuation, startup investing, or building startups in general. If you guys enjoyed it, make sure you give it a like and let me know in the comments what you think and what other videos you'd like to see from me. And with that being said, wish you guys the best and keep hustling.